Velodrome just hit 3 cents. Most holders are underwater. The chart looks brutal. But here's what nobody's talking about. While price is bleeding, the protocol just crushed over $500 million in volume last epoch. The fundamentals are screaming one thing, while price action whispers another. Token holders stayed flat at 30,000 for 6 months straight. Revenue sits at 14th among all decentralized exchanges. Active users? 19th place. And get this, they're about to drop Velo Launch, a product that could reshape how liquidity pools get created. So what's real here? The carnage on your screen or the data nobody's watching? I'm sitting in my accumulation zone with a max-locked veVELO position, stacking rewards every single week. Let me walk you through exactly what I'm seeing and why this might be the most asymmetric setup I've found in months. Let's start with what actually matters, the numbers. Epoch 176 just closed with 522 million in trading volume across the Superchain. That's the highest since January. Beyond Optimism mainnet alone, Velodrome pushed 162 million in volume. They distributed 189,000 in voting rewards to veVELO holders. And they're now the #1 decentralized exchange across 8 different chains. This isn't some ghost protocol. Real money is moving through these pools every single day. But check token terminal data. 30,000 token holders, completely flat for months. Revenue at 3.8 million over the last 6 months puts them 14th among exchanges. That's solid, but not explosive. Active monthly users hit 77,000, ranking 19th. Average trading volume per user is $5,000, placing them 11th. So we've got institutional-grade volume with mid-tier metrics everywhere else. The disconnect is wild. Here's where it gets interesting. When AWS went down recently and took half the crypto world offline, Velodrome didn't flinch. Not a single hiccup. Why? Because they're fully on-chain with zero centralized dependencies. No servers to crash. No single point of failure. This is the kind of infrastructure edge that scales infinitely at near-zero marginal cost. While competitors scramble during outages, Velodrome just keeps processing trades. That resilience is underpriced right now. Then there's the boosted rewards announcement tied to self-protocol verification for CeLO pools. We're talking 39 to 43% yields on verified stablecoin pairs. Some volatile pairs hitting similar rates. These aren't Ponzi numbers. These are protocol incentives designed to attract real liquidity before the next wave hits. Coming soon, Velo Launch. This is their answer to making pool creation dead simple. Guided user experience on easy mode. Claimable fees where liquidity providers get 100% of swap fees. Lock liquidity to prove commitment. Seamless discovery for emerging and listed pools. And permissionless deployment for any token, anytime. Think about what this opens up. Right now, launching a token with real liquidity is complicated and expensive. Velo Launch removes those barriers completely. For projects looking to bootstrap on Optimism or across the Superchain, this becomes the obvious choice. More pools mean more volume. More volume means more fees. More fees mean more rewards for veVELO holders. It's a flywheel waiting to spin. Now let's talk about what you actually came for, the price action. It's ugly. There's no sugarcoating this. Weekly time frame shows Velodrome trading at 3 cents after hitting an all-time high of 44 cents back in December 2024. I've anchored my Fibonacci retracement from that top to current lows around 3 cents. The 618 fib level, our golden zone, sits at 28 cents. Price is trapped in a falling wedge pattern, squeezed between converging trend lines. We're sitting right on support, inside my green accumulation zone, between 3 and 4 cents. Every exponential moving average is above us. The 10 and 21 EMAs in blue, 55 in purple, 100 in yellow. All resistance now. Price needs to reclaim that 21 EMA around 5 cents before we can even think about relief. But look back at October 2023 through March 2024. That period delivered an 1180% move from similar oversold conditions. The green box on my chart marks my dollar cost average zone, 3 to 4 cents. That's where I'm loading. Why? Because the risk-reward ratio is absurd. My stop loss sits at that red dashed line. If we get a weekly candle close below it, short-term traders should exit. But I'm building a long-term position because I'm actually using this protocol. I've got veVELO max locked, earning incentives every epoch. Even if we drop to 2 cents, I'll reaccumulate there. The Fibonacci RSI indicator below the chart is deep in bearish territory, absolutely oversold, printing its 5th consecutive red candle. Volume profile shows point of control at 5 cents, acting like a price magnet. My 6 take-profit targets: 6 cents, 12, 19, 28, 45, and 70 cents. I'm trimming 25% at the first target. Then I trail my stop loss as each level hits. Target 1 reached. Stop moves to entry. Target 2 hit. Stop moves to target 1. Risk-free trade structure. Let's be real. Most people holding Velodrome right now are down bad. If you bought anywhere near the top and didn't dollar cost average to take profits during the February and May pumps, you're sitting on heavy losses. The chart looks terrible. Momentum is bearish. Retail sentiment is dead. But that's exactly when asymmetric opportunities appear. The mismatch between protocol fundamentals and token price creates the setup. Tight stop loss at current levels means you're risking pennies to potentially make multiples. The protocol keeps building. Volume keeps flowing. Yields keep paying. Eventually, price catches up to reality. Or it doesn't, and you take a small controlled loss. That's the trade. Nothing guaranteed. Just probabilities stacked in an interesting direction for those willing to sit in discomfort while others capitulate. So there it is. Velodrome at 3 cents with $500 million epochs, resilient infrastructure, upcoming product launches, and a community of locked holders earning every week. The chart is a disaster. The fundamentals keep strengthening. I'm accumulating in this zone because I believe in what they're building and the risk-reward makes sense for my strategy. If you found value here, hit that like button. Subscribe if you want more daily, unfiltered analysis. Join my free Telegram group, links in the pinned comment below. And if you're curious about my previous Velodrome coverage, check out those 2 videos on screen now. They'll give you the full context on how we got here. Thanks for watching. Never financial advice. See you tomorrow in the next one.